we are going to see an increase of $83,000, $385 on a $400,000 investment.
But that's only the tip of the iceberg.
Welcome back to Really Mary. I'm here with Randy Williams from TBF Mortgage, and I'm Mary Bartos. And we're here to talk about something near and dear to our heart, and that is affordability. So, Randy, what are the three things that go into affordability?
Yeah, a combination of your wages or income, your mortgage rates, and the home prices.
Right. And so let's look at wages at first. You know, I love this slide that shows wages are climbing at a faster pace, right? And if you look at that at the end of it, which is where we are, there's that little arrow that's pointing up. The wage index trend line is in the blue dots, and the green kind of goes up and around it. And look at where we are. Do we have a wage issue right now, Randy?
No, wages are keeping up with rising home prices and rising interest rates. So that's a good thing.
That's a good thing.
Yeah.
So that's not an issue. Let's talk about mortgage rates, because I know they could be a little difficult in what we thought they were going to be and where they were and all that sort of stuff. So remind me what NerdWallet says.
The Federal Reserve influences mortgage rates, but it doesn't set them. At this March 2024 meeting, the central bank kept federal funds rate unchanged, said it will keep an eye on economic developments to decide when the next rate move will be. Mortgage rates are influenced by many elements, including the inflation rate, the pace of job creation, whether the economy is growing or shrinking. The Federal Reserve's monetary policy is a factor too, and it is set by the Federal Open Market Committee.
You know, they just went through this on March 20th, was it? 2024?
Right.
And what did they do? They just decided to maintain it, not cut it, not increase it, just kind of.
We're all waiting for the rates to come back, but we keep getting good GDP numbers. We keep getting good job growth numbers. We keep getting good low unemployment numbers. So what's the incentive? Like, honestly, what is the incentive at this point?
Well, the incentive should come down, right? Because inflation, let's face it, they go back to the 70s, and we've shown that chart, on our housing update or something, that showed inflation went way high, and they let the interest rates come down sooner than they should have, and it spiked again. So they're all a little afraid of that, I feel. That's all they're talking about. It's not about whether or not they're going to cut the rate. It's just timing. And they keep saying it, timing. Yeah.
Are we going to time this correctly? You're exactly right.
So, when you start looking at that, and Forbes, what did Forbes say?
Current expectations are that the Fed will start to cut rates at some point between June and September. The exact timing depends on how incoming economic data looks. The Fed's March meeting did not set up a prospective near-term interest rate cut, but a summer cut appears likely.
Which they've been talking about for a while.
Yeah.
Now, before we talk about what their analysts are saying about that, let's just remind everybody about demand-based rate environment. When we're at closer to 7, right, and 7.5 in that range, we have weak or limited demand. As we get down into the 5.5 to 6.5 range, we're going to go to good and strong demand. So we know, and, Barbara Corcoran said it, just recently, when those rates come down, the floodgates are going to open again, and we're going to start to see buyers that were quietly sitting on the sidelines jump back in.
I think they're going to slow play it. I think they're going to do minimal rate cuts and slowly do it. You're not going to see one big rate cut.
Nice. Well, you've heard it here. We'll see if that plays out, but I like what he's saying. Lawrence Yun, what is he saying?
Housing demand has been on a steady rise due to population and job growth, though the actual timing of purchases will be determined by prevailing mortgage rates and wider inventory choices. Yeah.
Yeah. Makes sense. Right? Common sense. And if we go on and say what our good friend Adetta Kushi says.
When you zoom out, affordability is still very, very low from a historical perspective.
Yeah.
True.
So let's go on to this next slide, because, Randy, this is kind of an interesting slide.
Yeah.
The affordability index, when it gets to be a bigger number, right, that's when it's super affordable. And when it gets to be a smaller number, it's not. So they're looking at this back. Do you have your eyes on? Can you see that? Is that back to 1990?
90.
Right? Yep. 90 to 23. It's in big letters at the top.
Yeah.
And I'm trying to look at the little bitty ones at the bottom, and I'm like, I can't see it. Anyway, we know the years of distressed properties, very affordable, right?
Right.
That's all in orange. And we look at the unicorn years that came after that, right? And now look what's happening. We're in blue. We're still at a very affordable rate.
Yeah. And I mean, we've overcorrected. We all know it. We had a smoking hot market during COVID, and they overcorrected. and they're just going to balance it out to something normal.
Normal's good.
Yeah.
Mortgage rate projections. This is up from our housing update from last March.
Yeah.
Not last March, from March in 2024, not in 23.
Yeah.
Right? Because they said in fourth quarter it was going to have a 5 in the first digit.
I'm still bullish on it. Like we've been gosh, they've gone up again in the last couple of weeks, and it's a hard thing to square, but we know where this is going to end up. Again, it's not about if, it is about when, and they're just going to try to time it right.
Yep. So home price forecast, this is still really awesome. The top 7 analysts are saying 3.2% increase in prices in 2024.
When I see this, I think this is a positive investment for me.
Yeah. Right.
That's what I see.
Exactly.
That's all I see right when I see this.
Exactly. And maybe get some good deals right now.
Better than you were going to get,
right?
3 or 4 years ago.
Right,
You're going to get the home at the price you want it right now.
Right.
Rates are going to do what they're going to do. There'll always be an opportunity to peel back your mortgage payment if rates come down.
But there's not going to be 100 people on that one house waiting to pounce. And that's the benefit. You have some time. You can, look through it. You're not paying over, all the things. You're not giving up inspections, all the things that you need to do in order in those unicorn years to win. Mm-hmm. We're now back to a good level market. Mm-hmm. So what is Realtor.com saying?
Among the top considerations are the financial costs and benefits of renting versus owning. One approach is to compare the monthly cost of renting a home against buying a home. With such cost comparisons, we can identify whether market favors renting or buying. This is particularly important given today's landscape marked by the elevated mortgage rates and still high home prices, posing substantial challenges for would-be homebuyers. I still don't think there's ever an opportunity where renting is better than buying.
Well, me either. And I love this one slide, Randy. Let me get to it here.
Yeah.
So this is a slide that's median asking rate in the 50 largest metros. And they're looking at rents from overall, but studio, 1 bedroom, 2 bedroom, they're giving you an average. Mm-hmm. And then that monthly rent payment is $1,984. It doesn't tell us it does on the next slide. It's like an average of $400. Let's take Naples, Florida. Naples, Florida, average to buy right now is $600,000.
Yep.
But rent is $5,000 a month.
Right.
Now, and if you need a source on that, we'll give it to you. But one of our agents has been looking at it and came up with that. It's about $5,000 a month. Mm-hmm. And we just did a calculation. What was the mortgage on that $600,000?
You have to have a down payment and obviously some closing costs and things like that. But I think the monthly payment was about $200 shorter. It was like $4,800 and some change, maybe.
Yeah. Right. Exactly. Yeah. And that's on a 607. Now, some of our markets, like we've got in Fort Myers and Cape Coral, they're shy of the 400,000 mark.
Right.
So those are going to have less of a payment. If they rent in those areas, there's going to be less of a rent, but it's pretty significant. Now, if we look at investing that based on what those guys just said, the analysts said, of the average of what it's going to do in the next 4 or 5 years, we are going to see an increase of $83,000, $385 on a $400,000 investment.
I don't want to make light of saving $200 a month on rent versus mortgage, but that's only the tip of the iceberg. Where is that money going? If you're renting, that money is going to make somebody else wealthy.
Right.
That other person is going to gain appreciation. If you're paying it, you're paying down your principal. Hopefully, these numbers right here will entice you to think that your property is going to gain value.
Right.
So that money that's going towards something is either going to build your family's wealth or somebody else's. So it's not just the monthly payment.
Absolutely. And the dirt, somebody told me once a long, long time ago, put your money in the dirt. Because I've lost lots of money in the stock market, right?
Yeah.
I can't ever seem to time that right, or something happens, I've gained some money too, but I've never lost money because I can decide when I'm going to move in a house.
It's so beyond your control. What economic factors choose the stocks to go up and down are not something that you really have a whole lot of control over. You have to trust people.
Yeah.
But a home is something that's always going to be needed by people to live in. And if you're investing in a good place where we are, that's something that we know. Like, we know that that's a solid investment.
That's right. So one last couple more slides, I think, Randy. Tell me about what NerdWallet is saying on this.
From high prices to low inventory, potential homebuyers know it's gnarly out there. But if you're ready for homeownership, the long-term benefit of buying often outweighs the pain of toughing out a search, even in these days. True.
True. So,
Yeah.
if you're concerned because of affordability, talk with a great lender. Randy is happy to help you. We can get you into a house that makes sense for you, but you got to live somewhere, and you might as well put your money towards something that appreciates and not gives it to somebody else. So until next time, I'm Mary Bartos with Bartos Group of Premier Plus Realty.
Randy Williams with TBF Mortgage.
And we'll see you on the next Really Mary.